Hey traders, Raghee here. Great to see everybody. Happy Tuesday. We've got the aftermath of the CPI. So if you caught yesterday's free video, you know that what we were looking for, and let me show you here real quick what we're dealing with. So this is a 2-minute chart of, get this out of the way. It's a 2-minute chart of the NASDAQ. And CPI comes out, we see the weakness that's let's put this weakness into context for a moment. Let's take a look at the S&P. So we see the weakness that's come out because the number indicates a hotter inflation. And this is exactly the two different scenarios we could see. This is exactly the scenario of a better than expected. I do expect the market to take a lot of this back, but let's put this into context. Is this a major sell-off within what we've been seeing over the past 2-3 weeks? Are we seeing the kind of sell-off that's taking back a lot of the gains? Oh gosh, no, right? What's really interesting is we have Bostic today, twice, FOMC member Bostic, and then starting tomorrow we have Powell. So this makes all of those FOMC events a lot more interesting, a lot more impactful, because how do they want to spin this? Well, we've got this under control. It's transitory. It's energy costs. It's whatever. So look for a lot of this to be walked back. But this is the reaction we're going to see when good news, in other words, news that indicates the economy is hotter than it is shown by CPI, PCE, GDP, and jobs numbers, non-farm payroll, initial claims. So these are the kind of economic events and the reactions that we could expect to see going forward. All right, so let's get to the questions here. As always, taking a look at the daily time frames. Let's get to work. All right. So first up is, let's see. Can I explain the difference between inflation and reflation? It's almost the same thing. Reflation, inflation, it's the same thing. So reflation is the increase of inflation after inflation was moving lower. So reflation actually is a little bit more indicative of the downtrend in inflation and then the uptrend in inflation. So it's the same thing. It's just fancy speak, fancy techno babble for the market. Again, reflation is sort of the downtrend of inflation, and then the uptrend. And in the uptrend, we consider that as in to reflate, reflation. So really, really simple. It's just an increase of inflation. And they are really basically the same thing, but much more indicative of where it was, inflation, to where it is now. Just a trend shift, really. So thanks for the question. Hey there, Rolex. With CPI number coming in hot, yes. It wasn't stupid hot, right? It wasn't crazy hot. It was just, again, based on what we expected. Let's check out Forex Factory here. And you take a look at the CPI number coming in 0.9. Again, if you watched the video yesterday, I was very specific. If it's greater than the previous and greater than the expectation, we're going to see that sell-off reaction. Not that we're going to sell off all day, but there is a sell-off reaction. And if you take a look at this trend, let's do this here. All right. So this is the trend in the CPI. You see that? And what's interesting is what was expected, what we got. What was expected, what we got. So expectations, meaning economic guesstimates, are lower, have been lower the last 4 releases. So that's telling you something. I don't know if economists are sort of taking the FOMC's opinion at face value, and then that's the lower expectation, but the number comes out and it's far higher. So is this transitory? Look, inflation is, Rolex, I know this is going to sound crazy, but this is the way the market works. Inflation is whatever the Fed says it is, because they've got their hands on the levers of money printing and asset purchases and monetary policy messaging, and ultimately monetary policy itself. Inflation is whatever they say it is. I know that sounds ridiculous, but remember, that's the way the markets are going to react. If the Federal Reserve says, no, 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 don't worry about it, here's why I say that. If the Fed says, don't worry about it, what do we know that means then consequently to monetary policy? It means that they're not going to do anything sooner than what we've already expected, 2023 to 25 basis point hikes. So that's what I mean by it is whatever they say it is. That's the reality we live in. Okay. So this is Oz and they are the wizard. So just keep that in mind. All right. Next up is, let's see, just install the indicators. Very helpful. Can I go over quickly how to interpret the V-score? When is it low? Is it good? So, Chai, you need to look at the V-score intraday or end of day within the scope of where it's been moving. So it's really more about where has it been based on where you've anchored it from and the high-low range. So a +1 is not inherently useful in terms of the standard deviation of the VWAP. Of -3, again, is not inherently useful. Although I will say, once we start getting beyond a +2 or a -2, we are at that point 2 standard deviations away from the mean, either 2 standard deviations above or 2 standard deviations below. You start pushing the 3, again, that bungee cord continues to get stretched. Having said that, it really does matter where that range has been. So we don't really want to focus on +1 is more important than +2. It's rather, where has it been intraday or end of day, and where are we within the context of sort of that normal operating range? Okay. So thanks for checking the indicator out. That's something that I created back in 2008 to rebuild my portfolio to understand how many standard deviations we had gone from the mean based on volume, because that's how you follow institutions. You don't follow institutions with price. You follow institutions with volume. And that's what I did back in 2008 to rebuild my portfolio. And I say rebuild, I went to cash, which is something I'll never do again, but that's for another episode of Charts and Coffee. Can I explain how to look for honey badger stocks? Okay, so that's a Johnism. And so for sure, talk to John in the Simpler Futures room or his mastery about what he defines. I can only tell you how I define a honey badger. So honey badger does mean a relative outperforming stock. So that's sort of the agreed upon metric, if you will, that it's a relative outperformer, meaning it's doing better than everything else. And honey badgers are strength names. Okay, so right now, if I were just to use that single metric and say, what's the honey badger amongst indices? Amongst the indices, the honey badger is the NASDAQ. Amongst sectors, I'd say honey badger is, say, healthcare. So it's a relative outperformer. Remember, relative outperformers are relative to typically what it would move with. Tech is a honey badger if you think of it that way. But let's add one more metric, and this is how I define a honey badger. A stock that's a relative outperformer in an environment where the market might be choppy or weak, ideally is also going to meet a second criteria, and that second criteria is it is not a heavily weighted stock within an actively traded ETF. In other words, it's got some separation from the passive investing world. So I look for those 2 criteria. Is the honey badger a relative outperformer? Yes, that's agreed upon for sure. The second criteria is how heavily weighted is it within the passive investing universe, namely those ETFs and indices. I want it to be more minimal. And the more minimal, the more that particular stock has the ability to do its own thing. And that's sort of the hallmark. That's the hallmark of a honey badger. It's able to do its own thing. If you don't know the verbiage, it's definitely a simpler verbiage. It's something that John created a long time ago based on a hilarious video on YouTube. And so that's the way I look at that. That's my definition of a honey badger. And that's the way I would go about looking for them. Double green. So let's put the Raghee verbiage in there. Double green with low weighting in sector and index ETFs. All right. Okay, next up is, good morning. Hey there, Alex. Thoughts on pins? Sure. Thoughts on pins. So it is double green and it is pulling back. And I think my bigger, our bigger story moving forward is this going to be a double green, run higher, trend follow into that 728 earnings? You're pretty much at the cutoff for me as of tomorrow. Inside of 14 days, and you probably already started to see that the implied volatility is starting to increase because we're getting closer and closer to that earnings release date. So inside 2 weeks, not that it's guaranteed vol crush misery, but if you're playing debits, as I prefer to do, long calls, long puts, if you're playing debits into high volatility events, you're going to be paying more. And that's where the vol crush would come. So in order to avoid vol crush, I really it's not a hard and fast cutoff, right? But I need to acknowledge that I really need to see a significant pullback inside of that 2-week window in order to not overpay. But here's the fact of the matter. I don't hold the position through earnings, but I do like to be more cognizant of the premium that starts to get factored in as we approach that earnings date. So yeah, it's buyable, right? It's buyable 2 weeks back, double green, Darvis, reversion to the mean inside the wave. Yeah, it's hard to say no to that one. So the only thing I would say is look at other names within the group that say pins is hanging out with, sort of going back to the earlier question about relative outperformance. So ARC-F has pins, and I'm trying to think who else in terms of decent volume. That might be about it. So yeah, I don't have a problem with it at all. No, and this could have some honey badger-esque-ness to it because it's not super heavily weighted within the indices or the sectors that are related to the indices, but rather mostly an ARC-F. Thank you very much for the questions. All right, next up. Oh, and by the way, I'll be in the futures room in 5 minutes to take you all through the open. I'll be with you from 9:20 to 11:30. We'll do some day trading, especially those of you that just took my playbook class. If you're in the futures room or the sector secrets room, we'll be doing a little bit of day trading in both those rooms. But today I've got my full open, single day that I do that in the futures room. And if you want to join us, you can check us out with a trial, $7 trial. Come check out what we're doing here in the futures room. All right, so let's see. Mike M would love to get the multi-stacked. At Mike M, so if you're looking for it, it's in the room. It's in all of the classes. The last 2 classes I've taught, they've been included with the resources. They're in the Sector Secrets Mastery Room Drive, and they are in the Futures Room Drive. So if you're looking at it, that is where that indicator is parked. All right, next up, 5-minute, put a V-score low. Would I buy or sell it? Well, think about the time. Think about the event. If you're looking at reacting to a high impact event, V-scores are nice. Don't get me wrong. They are helpful. But this is actually another type of setup that I call first come, first serve. It involves the volatility measurement, my HPMRs, which is a process I created using the volatility data from AutoChartist, and then I run it through a simple equation. And so really it's which end of the volatility does it go to first? A V-score and the HPMR would be necessary. It would be necessary for an ideal fade, but HPMR alone would do it. So you're really looking at a fade that took you into the range here on the YM in this area. So that's what I call a first come, first serve. And actually that trade initially happened right with the data. And then as you can see here now 5, 10, 15, 20, 25, 30. 30 minutes later, we're getting a retest of that area. So that's what I would use. It would be a buy predominantly. I would prefer to be long because the directional bias on the down, while not as good as the S&P and the Nas, is bullish. But it's the lower end we traded down into on the hotter than expected CPI. Thoughts on DIS? I can't say that I love it because DIS is a bit of a laggard in the narrative around the XLC. I know it had a good session, right? Yesterday, they're raising prices on their Disney Plus. But this is not a trend. The best thing I could say about Disney is, well, first of all, don't short it, right? So my thoughts on Disney, even before yesterday's move, and let's really take yesterday's move within context. It's so easy to look at it like this and go, oh my gosh, do this. And you go, oh, all right. When you look at Disney within the context of the trend that was before we went choppy and then for a little while double red, it's hard to want to short Disney because it never really broke the 200 exponential. And there is broadly going to be a certain amount of opinion that is just inherently bullish because Disney's able to tread water above that 200 EMA. I look at the 200 EMA as the equator. There's a northern hemisphere and there's a southern hemisphere and there's the equator that cuts the globe in half. In many ways, the 200 exponential is the equator for the bullish hemisphere and the bearish hemisphere. And that's the way that I look at that 200 exponential. I like the exponential, 6 of one, half dozen the other. You could use a simple, but I like the EMA. And as long as we're above that, there is a certain amount of support and or bullishness that I'm going to expect the closer and closer and closer we get to that equator. So this thing never really convincingly went bearish. And so bounces off the 200 indications with a slow stochastic or the ready aim fire. I don't love that move. It's not a trend, but clearly we don't want to short it with, what's in place and what we were working with. Hope that makes sense. So I think the easiest way to keep yourself, sort of on a very clear path is to have directional bias, is to know, do I want to be a buyer or seller? And I'll go so far as to say this. If I can't look at a chart and say, I clearly want to be a buyer or I clearly want to be a seller, it doesn't matter if it's a 1 minute chart or a weekly. If I can't look at it and get a clear directional bias, don't trade the stock or ETF or futures contract or currency, what have you. So that's really, really important. And that's one of the things we do in the mastery, by the way. Directional bias is what builds the watch list. The double green, the yellows, that dictates the health and the quality of the trend. And then therefore, as we look at the next step, the strategy that I'm going to deploy for that chart, for that symbol. So with that being said, boy, that 20 minutes flies by. Thank you as always for being part of Charts and Coffee. Appreciate the time. Love the fact that you guys are preparing for the market. Pleased that you're doing it with me. As always, be good to each other, and I'll see you tomorrow.